If you think you need thousands of dollars to start investing, you've already been sold the wrong story. Benjamin Graham would tell you this: the amount isn't the problem. The order is the problem. Because when you start with almost no money, one mistake doesn't just slow you down. It can erase months, sometimes even years, of progress. And the mistake usually isn't picking the wrong stock. The mistake is starting in a way that forces you to quit the first time life gets messy or the market gets loud. So, in this video, I'm going to show you exactly what to do with your first $10, $25, $50, $100, step by step, in a way that's investing, not gambling, with a real margin of safety. And before we even get to the first stock, I'm going to show you the most common trap people fall into when they start small, the trap that looks harmless because it's disguised as motivation. Quick note, this is education, not personalized financial advice. Use it to make smarter decisions, then tailor it to your situation. Now let's talk about the real world. Picture someone like you. Let's call him Alex. Alex is not lazy. Alex is not bad with money. Alex is normal. He has a job, bills, maybe a car payment, maybe student loans, maybe a family, maybe rent that somehow climbs every year like it's training for a marathon. At the end of the month, after groceries, gas, utilities, and that one unexpected expense that always shows up like it pays rent, Alex has maybe $40 left, $40. And Alex opens YouTube or TikTok or Reddit, and he sees a video that says, turn $40 into $4,000. This is the next AI stock. This is the next crypto that will 100x. This penny stock is about to explode. Buy calls, don't miss out. And it hits a nerve because Alex doesn't want to be rich for a yacht. Alex wants to be rich for peace. He wants the freedom to breathe. He wants retirement that doesn't feel like a cliff, so he's tempted. Because when you have almost no money, the slow path feels insulting. It feels like someone is telling you to walk to the moon. It's exactly where Graham becomes most valuable. Not when you have millions, but when you have almost nothing and you can't afford a single catastrophic mistake. Graham's entire philosophy starts with one moral principle: protect the investor from serious loss, not excitement. Not maximize bragging rights. Protect the investor from serious loss. That's the defensive investor mind. And here's the first uncomfortable truth. The market is not the first enemy of a small investor. The first enemy is fragility. When your finances are fragile, the market doesn't have to crash to hurt you. A flat tire can crash you. A medical bill can crash you. A layoff rumor can crash you. A few months of higher prices can crash you. That's why the real margin of safety for someone starting with $10 isn't a secret stock. It's a system that keeps you from being forced to sell at the worst possible time. So we're going to build this in the right order, because the order is the difference between I tried investing once and I became an investor. Here's the first step, and I need you to hear this clearly. Starting investing with almost no money does not begin with investing. It begins with making sure your life doesn't ambush your portfolio. If you don't have any buffer, even a tiny one, every dip in the market becomes personal. It's not volatility. It's, I might not make rent. That's not a moral failure. That's math. So your first job is to create a small shock absorber, a micro emergency fund, not 6 months, not some impossible number that makes you give up. I'm talking about a starter cushion, $100, then $250, then $500. And yes, while you're building it, you can still invest small amount, but you're building two things at once: a buffer for life and a habit for investing. Where does that buffer go? Not into a meme stock, not into a hot set. It goes somewhere boring. A high-yield savings account, a money market fund, short-term treasuries like T-bills, something that doesn't wake up moody and decide to drop 30% because a headline sneezed. Boring is not a weakness here. Boring is the moat. And if you have high-interest consumer debt, especially credit card debt, understand this. Paying down a 20% APR balance is not missing out on investing. It is investing. It's a guaranteed return in the most brutal, clean, unromantic way possible. Graham talked about safety and arithmetic. This is arithmetic. When you start small, fees and interest don't nibble at your progress. They eat it. Now, once you have that tiny buffer forming, we move to the next step, the one that feels too basic for social media, but is, quietly, one of the highest returns you can get in America. If your employer offers a 401k match and you're not taking it, you are leaving money on the table. A match is one of the only times in investing where you can look at a number and say, this is immediate, this is real, and it doesn't require predicting anything. If you can contribute enough to get the full match, do that before you chase anything exciting. That match is your first margin of safety. And if you don't have a 401k match, or you're self-employed, or you're working gig jobs, that's fine. You still have the next tool, an IRA. Often a Roth IRA for many younger workers, though the right choice depends on your income and tax situation. The point isn't the acronym. The point is structure. Graham didn't worship complexity. He worshiped discipline and sound structure. And in modern America, retirement accounts are part of that structure because they help you do the most important thing: keep investing through noise. Now, here's where most people starting with little money get pulled into the trap. They open a brokerage app, see they can buy fractional shares, see the confetti animation, and think, okay, what's the one stock that can change my life? That question is the trap, because that's not Graham's question. Graham's question is, how do I avoid being wrong in a way that destroys me? That's why he drew the line between investing and speculation. Investing in. Graham's view isn't about being right. It's about being safe enough that you can be wrong and still survive. Speculation is when your result depends on being right. And when you start with almost no money, most people unknowingly choose speculation because they're chasing speed. They chase the next Tesla. They chase the next Nvidia. They chase AI penny stocks. They chase crypto rebounds. They chase whatever is trending this week because it feels like the only way. But speed is expensive. It charges you in stress, bad decisions, and usually losses. So let me give you the simplest starting plan, and then I'll show you how to customize it without turning it into a casino. If you have $10 a week, or $25 a week, or $50 a month, your first goal is not to become a stock picker. Your first goal is to become consistent. Consistency is the engine. The amounts are the fuel. Most people obsess over fuel and ignore the engine. So here's your move. Automate. Set up an automatic transfer the day after you get paid, even if it's $10, especially if it's $10, because you're not just buying assets. You're buying insulation against your future self. You're taking the decision out of the moment where Mr. Market is yelling in your ear. And if you've never heard of Mr. Market, this is one of Graham's most useful ideas. He described the market like a moody business partner who shows up every day offering to buy your shares or sell you his at whatever price his emotions demand. Some days, Mr. Market is euphoric. He thinks everything will go up forever. Other days, he's depressed and convinced everything's worthless. Your job isn't to obey him. Your job is to use him. And automation is one of the cleanest ways to stop letting his mood become your strategy. Now, what do you actually buy when you start small? For most people, most of the time, the best starting point is a low-cost, broadly diversified index fund or ETF. Yes, I know, it sounds too simple. It sounds like something your high school teacher would say, but that simplicity is precisely why it works for the defensive investor. A broad market index fund is not exciting. It doesn't promise you a story. It doesn't whisper, "You're early." It gives you something far more valuable when you're starting with almost no money: diversification, low fees, and a high probability of staying invested. Fees matter more than you think when you start small. Not because the dollar amount is huge today, but because the habit compounds for decades. If you leak 1% a year in expenses and trading costs and little fees, you're not just paying a fee, you're paying with your future compounding. So you're looking for low expense ratios. You're looking for simplicity. You're looking for vehicles that don't require you to be a prophet. Now, at this point, a lot of smart people push back and say, but Graham was a value investor. He analyzed individual stocks. Why are we talking about index funds? Great. Let's be precise. Graham wrote for different types of investors. He described the defensive investor, someone who wants satisfactory results with minimal effort and minimal mistakes, and the enterprise investor, someone willing to do serious work, pursue better results. Most people who are starting with almost no money are not enterprising, even if they're intelligent, because being enterprising doesn't just mean being smart. It means having time, temperament, and a process, and the ability to stick to it when you're bored and when you're scared. Starting with a diversified, low-cost approach is not betraying value investing. It's practicing the heart of it: discipline and safety. Now, that doesn't mean you never buy individual stocks. It means you earn the right to. And before we get there, we need to fix one more problem that's unique to starting small: the illusion of zero cost. A lot of apps advertise commission-free trading, and you think, great, I can trade all day for free. But commission-free doesn't mean cost-free. There are spreads. There are execution differences. There are tax consequences in taxable accounts. And most of all, there's behavioral cost, the hidden fee of turning investing into entertainment. Because if you check your portfolio 10 times a day, your brain will start treating it like a slot machine. And a slot machine is designed for one thing: to keep you pulling the lever. Graham would call that speculation, not because you bought a stock, but because you turned the act into a game. So let's talk about a plan that works whether you have $10, $100, or $1,000. I want you to imagine your financial life like a bridge. You don't build a bridge to hold exactly the weight you expect. You build it with extra strength, but reality is messy. Trucks are heavier than predicted. Weather happens. Materials age. That extra strength is the margin of safety. In personal finance, your margin of safety looks like this: a small buffer of cash for shocks, a simple automated investing habit, low costs, diversification, and rules that you follow when you're emotional. That's the bridge. Now here's the part most people skip: asset allocation. Even with small money, allocation matters because it determines your behavior in crashes. Graham famously suggested a balanced approach between stocks and bonds for defensive investors with a range that could shift, but not extremes. The spirit of it is that you don't go all in on risk and you don't go all in on fear. You keep a sensible mix that you can live with. In modern terms, depending on your age, stability, and risk tolerance, that might mean something like a stock-heavy allocation if you're young and stable, or more bonds and cash if you're closer to retirement or your income is shaky. The perfect percentage matters. Less than this. Choose an allocation you can stick with when the market drops, because it will drop. And when it drops, you will meet the real version of yourself. Now, let's go back to Alex for a second, because this is where the emotional reality hits. Alex finally starts. He automates $25 a week. He buys a broad market ETF. He feels strangely underwhelmed. No fireworks, no dopamine. Then the market runs up and everyone's posting gains. AI is everywhere. Headlines scream about the next big thing. Crypto is pumping again. Some story stock is trending, and Alex thinks, my boring ETF is too slow. I need something with more juice. This is where the danger is highest, not when Alex is scared, when Alex is impatient, because impatience is what transforms a defensive plan into a speculative mess. So here's the rule that saves people starting small. If you want to pick individual stocks, create a sandbox. A sandbox is a small capped portion of your investing, maybe 5% to 10%, where you can learn, experiment, and scratch the curiosity itch without risking your future. The other 90% stays boring, diversified, and automated. This does two things. First, it protects you from the one big bet that wipes you out. Second, it lets you learn without pretending you're Warren Buffett on day one. Now, if you do enter the sandbox, you need a checklist, not a vibe, not a story. Graham didn't invest by falling in love with narratives. He invested with standards. So here's a simplified Graham-style checklist you can use without becoming an accountant overnight. 1. Financial strength. Does the company have a reasonable balance sheet? Not drowning in debt? Enough liquidity to handle stress? 2. Earnings stability. Is this a business with a record of real earnings power, not just a dream of future profits? 3. Valuation discipline. Are you paying a price that leaves room for disappointment? That's the margin of safety in practice. 4. Shareholder friendliness, not hype, reality. How does the company treat owners over time? 5. Understandability. If you can't explain how the business makes money in plain language, you're not investing, you're speculating. Notice what's missing. But everyone says it's going to the moon. That's not analysis. That's Mr. Market in a costume. And here's another truth that matters when you're starting with almost no money. You don't need to hit home runs. You need to avoid strikeouts. Social media makes investing look like it's about huge wins, but real wealth for the middle class is more often built by not blowing up, not paying high fees, not panic selling, not chasing every trend, not using leverage you don't understand, not turning options into lottery tickets, not confusing a great company with a great price. That last one is massive. A great company can be a terrible investment if you pay too much. Graham practically tattooed this idea into investing. Price and value are not the same thing. Price is what you pay. Value is what you get. And when you start small, the market will constantly tempt you to pay a high price for a good story because it feels safer to buy what everyone loves. But paying too much is how people lose money in safe names. Now let's address something that might be sitting in the back of your mind. Okay, but if I'm only investing $10 or $25, does it even matter? Yes, and the reason isn't magic. The reason is identity. If you build the habit now, when it's hard, you become the kind of person who invests when it's easy. Most people do the opposite. They wait until they have real money. Then they try to suddenly become disciplined, and they discover discipline doesn't arrive in a package when your account hits a certain number. Discipline is trained. It's trained in the small reps. It's trained when you invest during boring months. It's trained when you keep going during scary months. And it's trained when you don't break your plan just because someone on the internet found a new shiny object. Now let's talk about the moment that defines almost every investor's future. The first real crash you experience while you're invested. It doesn't have to be 2008. It could be a sharp bear market, a recession scare, a sudden drawdown, a period where interest rates rise and valuations compress, or just one of those years where everything feels like it's leaking. When that happens, Mr. Market will show up at your door with a very convincing argument. See, investing doesn't work. You were wrong. You should sell before it gets worse. And if you started without a buffer, without an allocation, you can tolerate. Without a plan, you will believe him, because you'll feel trapped. This is why the order matters. Your buffer prevents forced selling. Your automation prevents emotional timing. Your allocation prevents panic. Your diversification prevents one mistake from destroying you, and your low costs prevent you from bleeding quietly. So what do you do in a crash? You do the thing that sounds simple and feels impossible. You keep contributing, not blindly, not recklessly, but mechanically. This is where dollar cost averaging actually becomes more than a slogan. When prices are lower, your same contribution buys more shares. You're not celebrating a crash, you're using it. And if you have an allocation, say, you decided on a stock and bond mix, rebalancing becomes your anti-emotion tool. When stocks drop, your allocation drifts. Rebalancing nudges you to buy what's down and trim what's up without guessing the future. That's what the defensive investor does, not because it's exciting, but because it's sane. Now let's return to Alex, because here's the full circle. In the beginning, Alex thought his problem was that he didn't have enough money. But the real problem was that he didn't have a system strong enough to survive his own emotions and life's randomness. Once Alex built the buffer, even a small one, he stopped feeling like every market move was a threat. Once he automated even $10 a week, he stopped relying on motivation. Once he chose low-cost diversification as his core, he stopped needing to be right about one company. And when he wanted to learn stock picking, he used a sandbox and a checklist, not vibes and headline. Now, Alex still isn't rich overnight, but he's no longer fragile. And that is what most people are actually chasing when they say they want to be rich. They're chasing the ability to take a hit and stay standing. That's the margin of safety. So let me give you a simple 48-hour setup you can do starting today. Whether you're starting small, starting late, or restarting after mistakes. Within the next 48 hours, first, set up a starter buffer. Open a high-yield savings account or choose a safe, cash-like option and start with a tiny target, $100. Don't overthink it, just start building the shock absorber. Second, if you have a 401k match, adjust your contribution to capture it. If you don't, open an IRA or a plain brokerage account at a reputable provider. The goal is simplicity and low costs. Third, automate a small amount. $10 a week is not embarrassing. It's powerful. Automation is how you beat Mr. Market without fighting him every day. Fourth, pick one simple core investment you understand, a broad market index fund or ETF with low expenses, and stick with it as the foundation. Fifth, write down one rule you will follow when the market drops. Something like, if the market falls 20%, I do not sell. I keep my automatic contributions on. Put it somewhere you'll see it. That's a defensive investor blueprint for someone starting with almost no money. And if you want a sentence that captures Graham's spirit in modern life, it's this. Your goal is not to be brilliant. Your goal is to be unbreakable. Because once you're unbreakable, time does the heavy lifting. Compounding isn't just a math formula, it's a reward for staying in the game. And staying in the game is mostly about not sabotaging yourself with avoidable mistakes. So if you're starting with almost no money, don't let anyone shame you for being small. Small is where real investors are born. Start with the right order. Build your margin of safety. Automate. Keep it boring on purpose. Use Mr. Market instead of obeying him. And one day, you'll look back and realize the moment you became an investor wasn't when you had a big balance. It was when you made a small commitment that you refused to break. If you want, in the next video, we can go deeper into a Graham checklist for picking individual stocks responsibly. The kind of checklist that keeps you out of story stock traps, hype cycles, and expensive mistakes, especially in loud markets. But for today, if you do nothing else, do this one thing. Set the automatic contribution, because your future self doesn't need you to be a genius. Your future self needs you to be consistent.